Hey everyone, welcome back to Corporate Decoder, the place where we try to decode the mysteries of the financial world in a way that actually makes sense and doesn't put you to sleep. Today we're diving into the DoubleLine Income Solutions Fund Report for the 30th of September 2025. And let me tell you folks, this one's a doozy. Get ready. Because we're going to unpack some serious financial details and maybe even find a hidden gem or two. Before we dive in, if you love getting easy to understand breakdowns of complex financial documents, make sure you hit that subscribe button. And hey, we've got an awesome community forming over on Discord where we discuss these filings even further. The link is in the description below, so join us. Alright, let's cut to the chase. This report is all about a fund, basically a big money pool that invests in a bunch of different things. Think of it as a financial buffet managed by experts. Our focus today is the DoubleLine Income Solutions Fund, and they've just released their annual report. So what is the story here? Well, DoubleLine's fund apparently did better than its main comparison index, which is great news. The report says the main reason for this success was their smart choices about where to put the money. They put a lot into areas like emerging market corporate bonds, which did really well. They also did well with structured credit things like loans backed by other loans and commercial property loans. These areas got a lot of investor attention and also paid out good interest. The only area that didn't do so well was government debt, specifically longer term US Treasury bonds, which lost value during this period. Let's look at some numbers for the 1 year leading up to September 2025. The fund's value based on its net asset value, or NAV, went up by 8.13%. That is pretty solid. Compare that to their benchmark index, the Bloomberg Global Aggregate Bond Index, which only grew by 2.40% over 3 years. The fund saw a fantastic 13.10% annualized return on NAV, while the index managed only 5.45%. Even looking at 10 years, the fund has delivered a respectable 5.53% annualized return on NAV. Now, let's get into the nitty-gritty. What exactly are they invested in? This is where things get really interesting. Their portfolio is huge, spread across various types of investments. They have a big slice in bank loans, making up 26.7% of their assets. That is a massive chunk. They're also heavily invested in foreign corporate bonds at 30.1% and US corporate bonds at 22.2% of their net assets. These three categories alone make up a significant portion of their holdings, showing a clear strategy to focus on corporate debt across different markets. Let's zoom in on these bank loans. This section of the report lists many specific companies that the fund has lent money to. For instance, they have a substantial investment in 1261-229, BC Limited, with a principal amount of over $6.7 million, paying an interest rate of 10.41%. They're also invested in Accurus Finance US Incorporated with over $3 million and a 7.75% interest rate. This indicates a strategy focused on providing direct loans rather than just buying bonds. In their foreign corporate bonds section, we see investments like Adani Ports and Special Economic Zone Limited, with over $9.5 million in principal and a 5% interest rate maturing in 2041. They also have a large holding in Banco de Vivienda SAR, with a principal amount of $17 million paying 6.65% interest and maturing in 2031. This spread across different countries highlights their global investment approach. Looking at US corporate bonds, they've got a variety of companies. For example, they've invested over $4.8 million in Anywhere Real Estate Group, LLC paying 9.75% interest, and over $7.5 million in Castle, US holding corporation paying 10% interest. Let's glance at the big picture of their financial health as of the 30th of September 2025. Their total investments are valued at over $1.8 billion. On the debt side, they have a loan payable of a staggering $395 million. This means they're using a lot of borrowed money to invest, which they call leverage. For the year ending September 2025, the fund generated over $155 million in interest income. That is a massive amount. However, they also paid out over $21 million in interest expense on their borrowings, and nearly $18 million in investment advisory fees. Most of their expenses are related to these borrowings and management fees. Now, for the yearly performance summary for the year ending September 2025, the total return on net asset value was 8.13%. While this sounds good, it is important to remember this comes with all the risks we've discussed. Even though they made a profit of 8.13%, they also paid out $1.32 per S-share in distributions. A mix of income and return of capital. Looking back, 2022 was a tough year for them, with a negative return of over 26% on net asset value. This report is packed with risks, and they want investors to know about every single one. They talk about the risks of investing in asset-backed securities, collateralized debt obligations, credit default swaps, and the big one, interest rate risk. This is the danger that as interest rates go up, the value of their bond investments generally goes down. Given how much they invest in bonds and loans, this is a really important one to watch. They also highlight emerging markets risk, meaning investing in developing countries can be more unpredictable and risky. They are also very upfront about leverage risk, explaining that while it can boost returns, it also magnifies losses. The team managing this fund includes Jeffrey E. Gundlach, Luz M. Padilla, and Robert Cohen. These are the folks making the investment decisions. It is reassuring to see they have experienced individuals at the helm. The fund's main goal is high current income and then capital appreciation. They aim to achieve this by investing in debt securities and other income, producing things all over the world, including in developing countries. They might have up to 80% of their assets in global debt and won't typically put more than 50% into a single debt category. They also mention they might invest without limit in securities rated below investment grade, which means they can invest in riskier, high-yield bonds. This is a key part of their strategy, aiming for higher income by taking on more risk. Let's talk about leverage again. The fund has a credit facility, basically a big loan, for up to $450 million. As of this report, they borrowed $395 million. They're paying about 5.09% interest on this borrowed money. This leverage is a big boost when investments do well, but it also amplifies losses if things go south. The report dives deep into the rules and risks associated with this leverage, especially how it impacts shareholders. They even have a section called Effects of Leverage, showing hypothetical returns based on different portfolio performance. If the portfolio returns negative 10%, the shareholder return could be a whopping negative 14.18%. That's how leverage works. It is a double-edged sword. It is always interesting to see how these funds vote on company matters when they own shares. DoubleLine has clear policies on this, generally aiming to vote in the best interest of their clients. They tend to support proposals that align with shareholder value, independent director elections, and even things like human rights and climate disclosures. However, they do consider things on a case-by-case basis and may vote against proposals if they think it is not in the best interest of their clients or if it is too costly. This shows a thoughtful approach to corporate governance. So, what is the verdict on DoubleLine Income Solutions Fund? It seems like they're actively managing the fund, making strategic bets in areas like corporate debt and global markets, and aren't afraid to use leverage to potentially boost returns. The performance numbers look strong compared to the benchmark, but the extensive risk disclosures, especially around leverage and interest rate sensitivity, are a big red flag. Investors need to understand that the high income they aim for comes with significant risks, and the use of leverage means that losses can be amplified. It is a fund for those who understand and can tolerate higher risk for potentially higher rewards. Alright? That is our deep dive into the DoubleLine Income Solutions Fund report. What are your thoughts on their investment strategy and their use of leverage? Do you think it's a smart move or too risky? Let us know in the comments below if you found this breakdown helpful. Please give it a like and subscribe for more content like this. And don't forget to join our Discord. Thanks for watching, and we'll see you in the next video.